Well, today we heard from the FOMC that there's no inflation in sight. So does everyone agree with that? Well, our next guest, Martin Hegarty, runs a fixed income portfolio at BlackRock. He's the co-head of global inflation-linked portfolios. You run about, what, $4 to $5 billion for starters. I think you actually have several portfolios under your auspices. Martin, so lay it out for us. The Fed doesn't see inflation, but how long are we just going to be stuck in this zone where there's supposedly no inflation and yet everyone thinks it's out there?
Well, firstly, thanks for having me, Adam. I think the key ingredient that we haven't seen yet to spark inflation in the U.S. has actually been some wage growth. Wage expectations are very low, and very little average hourly earnings. People aren't seeing an increase in the average hourly earnings. So until we actually see that start to come through in the data, we're probably not going to see any signs of embedded inflation. You've had higher energy prices, et cetera, at the beginning of the year, push core inflation up. We've had a massive rebound in the rental market, which has driven 40% of core CPI higher. So if we look compared to where we were in Q4 last year, where year-on-year inflation was printing at 0.6, you know, if you annualize some of the last prints, we're almost running at 3%. But at BlackRock, we do think that core inflation is going to peak in the first quarter of next year, and headline inflation is actually already on the way down.
So if it peaks, it then backs off?
We think it's going to peak and back off somewhat, not to the levels that we saw in 2009 and 2010. But we do think it's going to back off. You know, we see core peaking at around 2.1, 2.2 in March, April next year, and then probably backing off to the 1.7, 1.8 level by the end of 2012.
So in other words, you'd agree with the Fed that there really is no inflation to speak of in the next several years?
Definitely not embedded inflation, that's for sure. And as I alluded to, a lot of the inflation that the man in the street perceives is definitely indexed to gasoline prices. And we've seen gasoline prices since the Arab Spring, and I guess the global shortage of Brent crude as a result of Libya supplies shut in actually retreats somewhat from the highs that we were at earlier in the spring.
You know, that's a great point, actually. You talk about gasoline. If you were to take gas, and I know it's kind of impossible to do, it's like if you get your report card and you say, oh, if you don't look at the C that I got in math, I was an A+ student. But if you were to take gasoline out of the equation, where do you think inflation would really be?
Well, if you look at how CPI data is determined, you know, gasoline is only a 7 or 8% contribution to the month-on-month number, yet that's what it is actually in the formula. Yet on a month-on-month basis, it is the biggest driver of the volatility. So if we look back over the last 3 years, I can remember in 2007 and 2008, oil moved from $45 to $150, and headline inflation was running very, very high, and the Fed were cutting rates in 2008 on fears of the housing market. And headline inflation ran way ahead of what it should have done, and once energy retreated, it actually reversed all those gains. So if you look over the course of time, it's relatively in the 2.5% to 3% range, which ties in with the Fed's core PCE target of 1.8 to 2%.
All right, so at the end of the day, you've got several $1 billion that needs to find a home, and you're trying to protect against inflation that's down the road. What are you buying?
Well, the key thing when looking at TIPS, and as I've mentioned many times before, that TIPS protect inflation for fixed income investors. If we do experience a profound period of inflation, real rates will go up, so TIPS will struggle from an absolute perspective. But from a nominal bond holding perspective, if one switches out from nominal bonds into TIPS, they will be protected in that scenario. And what we've tried to do, given our view of inflation and the inflation dynamics for the next 12 to 24 months, we think that headline inflation is coming down. We think that core is on the way to peaking. We're trying to position where we think inflation expectations are the most undervalued on a longer-term basis. So what the Fed has achieved with Operation Twist and the various QE policies which they've implemented, they want long real rates as low as they can get them. And they've done that through Operation Twist by taking duration out of the market.
So Operation Twist is actually working. Whether or not you agree with it's another story, but at least it's working at bringing the long rate down.
Well, I personally agree with Operation Twist a lot more with QE1 and QE2, because what the QE1 and QE2 have done, well, they expanded the balance sheet, so getting money into the system. So if the transmission mechanism is working, that money goes to where it's needed. Now that the transmission mechanism is not really working properly, you have a flood of money sitting on balance sheets. You have a lot of people flocking to zero duration assets such as gold, and the one that hurts the consumer the most is oil. And you saw with QE2, net spec long positions in the front energy contracts surged, and that in turn put a massive pressure on the consumer as disposable income's not rising, and when you add on the energy tax on top of that, it puts them in a pretty bad position. So Operation Twist has actually had the effect of not expanding the balance sheet, keeping energy prices relatively well contained, while at the same time driving long real rates lower. And that is passing through into, I think, a lot of the economic data that we're seeing in Q4 so far.
All right. Explain for our viewers how it can be that there's a 30-year bond right now that trades assuming that rates are going to be 3%, and yet it just intuitively, just you and I talking right now, do we really think that 30 years from now the inflation rate's only going to be 3%? I mean, how is it that the market's putting 3% on it?
Well, as I said, the Fed has taken a substantial amount of duration out of the market, and they will continue to do that until the middle of next year. So I wouldn't say that 30-year treasuries at 3% are reflective of their risks in the market. And that is why, when you ask me how we're positioning, I think that over the course of the next 6 months, as the Fed takes duration out of the market, you are supposed to be replacing your 30-year treasuries with 30-year real rates, because it's very hard to ignore credit risk, as we've learned in the European situation. But if you ignore credit risk for the time being, and your risk return environment or scenario for 30-year treasuries at 3% is pretty poor. You're pricing in a pretty dire scenario. And I believe
Would you short that bond? Would you short the 30-year?
I think in the course of time, one is supposed to move to an underweight position, but I think that particularly in the run-up to year end, you may see continued pressure as people are already underweight. I don't think on an outstanding basis it offers much fundamental value. So in the inflation accounts that we do have that can trade nominal treasuries, we tend to be underweight nominal treasuries and overweight real rates, because I think explain what that means. Underweight, say it again, and just explain it in plain English. Well, when I was explaining to you about TIPS being a hedge for fixed income investors,
right?
If we look at 30-year break-even rate, which is basically the 30-year inflation rate priced into the bond market right now. So 30-year break-evens.
The difference between the yield on the TIPS, which adjusts for inflation, and the yield on just
on the corresponding nominal security.
Bond. Yep.
So 30-year TIPS, the difference, the yield spread between 30-year TIPS and 30-year treasuries right now is around 2.2%. And that is basically implying that if you own nominal treasuries for the next 30 years, rather than TIPS, you will benefit if inflation is under 2.2%. And if inflation is greater than 2.2%, you'll be benefit by owning TIPS.
Sounds like we ought to buy some TIPS.
Well, I just think from an absolute risk return standpoint, and you brought it up first, that 3% 30-year treasuries are not necessarily the soundest investment, I believe, right now on a standalone basis.
All right, Martin Hegarty of BlackRock, you manage billions in the Treasury inflation-adjusted securities. All right, Martin, thanks for joining us.